Hello, I'm Jeffrey Ham, equity analyst for Briefing.com. Today is Thursday, March 5th. The stock market completely reversed the prior session's rally by logging new multi-year lows during the session and closing at its worst level since the fourth quarter of 1996. Roughly 95% of the companies in the S&P 500 finished with a loss. Though losses were broad-based, financials were dealt the worst blow. The sector fell almost 10%. Moody's announced it is reviewing the credit ratings of Bank of America and Wells Fargo for possible downgrade. Moody's lowered its outlook for J.P. Morgan Chase to negative from stable. Sellers pushed both Wells Fargo and J.P. Morgan shares to new multi-year lows. Citigroup registered record lows by falling below $1 per share. Despite the weakness plaguing financial stocks, General Electric resisted much of the session's sweeping selling efforts. Concerns about the health of the company's capital arm have made the stock perform as if it were a financial holding. The company's CFO stated in a CNBC interview that GE does not need capital, helping calm concerns, at least for the time being. Automakers continue to struggle amid stiff macro headwinds. General Motors was hammered as fears of bankruptcy mounted after the company's auditor expressed concerns about GM's viability. Given GM's pleas for federal financing, market participants were already well aware of the automaker's problems. Retailers had an ugly session after a battery of companies reported grim same-store sales for February. However, companies catering to more cost-conscious consumers reported increased same-store sales. Aeropostale, Walmart, and Family Dollar were among the standouts. Weekly jobless claims for the week ended February 28th totaled 639,000. Continuing claims came in near 5.11 million. Though claims weren't as high as expected, job markets remain weak. With job losses mounting, many homeowners are unable to stay current on their mortgage payments. In turn, mortgage delinquencies as a percentage of total loans totaled 7.88% in the fourth quarter. That was up from the 6.99% delinquency rate in the third quarter. Fourth quarter non-farm productivity declined 0.4%. The lower reading was a result of lower economic output in the fourth quarter. I'm Jeffrey Ham for Briefing.com, and thanks for listening.